Hello, everyone. Today on the final bar, my guest is Jeff Huge from JWH Investments. We're going to talk about a bull scenario and a bear scenario and what the market might be pricing in here, where there are opportunities. Today the S&P really was in a position of strength, but by the end of the afternoon, sort of rolled back over and gave up much of the gains from earlier in the day. So overall, we're still in that holding period. What's the potential for upside and the potential for downside and greater risk management? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the lenses of technical analysis, behavioral finance, quantitative methods, investor sentiment, psychology, everything we can bring to bear to try to make sense of the choppiness and the uncertainty. I'm often asked, how do charts make sense when it's all this other stuff that's driving prices? It's the Fed, it's the elections, it's the coronavirus. It's not a technical thing. And my argument is now more than ever is the time to be looking at the charts because that tells you what's happening. All the investor expectations are priced into the market. That's the idea. So the price of an asset's going to tell you where people are expecting that to go and what their assumptions they're making about what could be going forward. So I would argue now more than ever is a really good time to pay attention to what's working and what's not, because more often than not, the reasons for why things move tend to be a lot clearer in the rearview mirror. Later is when you figure out why things played out in a certain way. For now, let's focus on identifying the trends, following those trends, trying to anticipate when those trends are reversing. Now, we have some great guests coming through the show regularly to help us answer those questions with us. Today, Jeff Huge from JWH Investments. I'm really excited to have him back on the show today. On Thursday of this week, we have Mark Young from Wall Street Sentiment. Mark focuses on the sentiment aspects and what investors are saying through survey data and other things. So it'll be really good on a big sentiment day on Thursday to get his take. And then next week, we have Sam Stovall from CFRA Research, who's not a technician. He's really more of a strategist, but with a great, charting overlay to what he does. It'll be very interesting to hear his take kind of going into election season. As a reminder, if you missed our special yesterday earlier this week on the presidential election cycle, we had a really good special with Jeff Hirsch, Tom McClellan, Bruce Frazier, and I talked about the historical data, what tends to happen given, who wins, what election years tend to look like, and what that means for you right now. And they each had ideas of where you should be positioned. So really worth a watch on our YouTube channel if you missed it on StockCharts TV on Monday. Let's get to our market recap. I did want to start with a poll. We always have a poll going on our StockCharts TV page, also anywhere where you see our content. Recently, sort of gave you a bit of a quiz here on behavioral finance. We said you decide you're bullish, then you start looking for evidence to support your bullish thesis. Which behavioral bias are you demonstrating there? 4 out of 5 of you answered absolutely correctly, which is confirmation bias. I got 19% of you with my fake answers, bullish bias, which is a way you might anecdotally describe somebody, but it's not actually a formal bias, and bad idea bias, which I can only assume 4% of you were appreciating my tongue-in-cheek answer. Endowment effect, the endowment bias, something different. That is similar in that it affects your ability to analyze things, but it is more about how you are hesitant to sell a position because of an emotional attachment to that thing, to that object, or to that position. So 4 out of 5 of you, absolutely right. Confirmation bias is where you preconceive your position. I'm bullish on the markets. Then you start gathering evidence and you try to back up essentially what your brain does is try to support, make you feel better, confirm your preconceived notion of what you think. What you want to do is flip that. Start with gathering evidence, then determine the weight of the evidence, then figure out how you should be positioned. So 4 out of 5 of you, well done. The other 20%, let's read up on the behavioral biases. So much to learn along those lines. Our market recap continuing on. So as I mentioned, the S&P in the morning really was strong, and this is coming after the last 2 days, which were really distributive. So it's a bit of a turn to the left turn, heading back to the positive side, but it gave up a lot of those gains going into the close. And again, I'm hesitant to draw too much of a conclusion just from that, but it certainly seems to buy into the choppiness aspect when you have half the day up, half the day down, you're overall sort of chopping around, sort of how things feel. We're sort of in this indecision mode as we have a lot of things like the stimulus, like the coronavirus, like the elections, which we're not going to get an immediate gratification on that. That's going to take a couple weeks to really play out. So, and also earnings and things like that. It'll be interesting to see if we can dramatically move out of the range we've been in. And today finished a little bit, weaker going to close. The S&P still up about 0.5% though to 34.43. Mid caps and small caps both up a little further. The Nasdaq was pretty much in line with the S&P. Looking at some other asset classes, yields higher today, almost 80 basis points on the 10-year, and the TLT, which is sort of a proxy for bond prices, was down about 1%. I was on Dale Pinkert's show, the Forex Analytics show this morning before the open, talking about different market, different asset classes, and he asked me about interest rates, a steepening curve, higher rates, what that means. And my general comment was, even if rates go up a lot from here, we're still really low relative to long-term levels. So I think if you're looking for yield, you're still not finding it in some of those really conservative assets. Looking in the income-oriented equities tends to be, a much greater opportunity. And utilities overall have been performing relatively well, and you could argue that's certainly a part of that, a hunt for income or hunt for yield. Gold finishing up about 0.5% with the GLD going up to 179. Oil stronger as well, which meant the energy sector was the number one sector out of the 11. Again, it's coming out of a pretty beaten down level, but noteworthy that it's at the top of the list today. So what does the chart of the S&P look like? Well, as I mentioned on Monday's show, we really dug into some of the different themes. And, I sort of, my weekend review of the S&P chart sort of gave me three main buckets. And again, there are some outliers like some energy, some financial, some healthcare. But if you look at the average stock in sort of the consumer technology industrials type of space, you have three buckets. You have stocks like Costco, which are making higher highs. You have stocks like Apple making a lower high, and the S&P is similar to the chart of Apple. Apple's just maybe a little more exaggerated, didn't get as near to its previous highs. And then you have something like a Netflix, which is really chopping around, making a bit of a triple top sort of pattern, a consistent resistance level. And the challenge for me with all of those patterns is they tend to be characteristic of market tops. This is what things start to top out like, where you have a market that's unable to eclipse its previous highs. An uptrend is made of higher highs and higher lows. I think we've now potentially established a lower high with the S&P petering out around 3550. We could reverse back to the upside and break above there. And if we get above 3,600, I will, again, sort of give the all clear. I think we've gotten to the rounding error of the September highs. And the question is, where do we go from here? My base case, if you ask me to say where I would expect a likely outcome, I think given the seasonal tendencies, and we talked a lot about this in our presidential cycle special, guys like Jeff Hirsch and Tom Clenn and Bruce Frazier had some really good insights on sort of the seasonal trends going into year end and how that relates to an election year. But overall, a weaker two, weakness pulling back to sort of the lower end of this range around 3,200, 3,300. And then a bit of an appreciation into year end would follow sort of the traditional seasonal pattern. Usually have a weaker October and before you rally into November and December. So I could see that lining up pretty well. That would sort of build up some more momentum and would clear the way to sort of have a new directional move going into the new year, going into January. But however, the way that you would break out of that is if you break below 3,200, which again feels like it's a long ways away. It's not that far away. It was a couple weeks ago we were down at these lows, but the S&P's ability to hold 3,200, I think, keeps that overall constructive or non-negative thesis in play. We break below there, I think you have to think about much deeper downturns. For now, it's charts like Costco for me, and just dealing with the fact. Oops, that's the wrong one. That's for the Q&A later. Sorry. If we get to this one, chart of Costco, for me, it's the bearish divergences that are materializing on charts like Costco. These are leadership names that have rallied to new highs. Overall, the trend is positive. So as I mentioned before, a couple questions you have to answer. Number one, where is the trend? It's hard to argue that the trend is not with Costco. It's a higher highs, higher lows. It's pulled back off the moving averages. It's rallied. The relative strength is strong. The RSI is in a bullish range. That's all positive. Step two is follow the trend. So overall, until we get proven otherwise, higher highs and higher lows, Costco's in an uptrend. I have no problem following that. But the third one is looking for potential inflection points, looking for opportunities or signals that the uptrend might be exhausted. I think that's what we're seeing here. So the trend's still positive. Sort of the red flag that the trend might be exhausted is what I'm seeing now. But between the lower highs and stocks making higher highs are seeing a negative divergence. That's sort of the average pattern that I'm seeing in some of these leadership stocks that have been doing well. So that can be invalidated if we continue to break to new highs, if that bearish divergence is minimized by the fact that we blow out to a higher momentum state. That would certainly change it. But overall, that's the thing I'm going to assume is just assume that we're sort of in that exhaustion point, limited upside. Staples and healthcare are the two worst sectors. Those are sort of flat today. We're going to look at a chart of a healthcare name in a little bit. I'm concerned about stocks like Merck, Johnson & Johnson testing long-term support. That's a sector where there are some opportunities, but there's some real dispersion between the haves and the have-nots within healthcare. Certain sectors are sort of all up, all down overall. Healthcare is one with a lot of differentiation, so worth paying attention to. Also, we don't have time to get through all the individual groups down here, but I would pay attention to some of these groups that are holding up well, that are trading to to new swing highs. Not many of them. The groups that are up today are not up big on a long-term basis. It's sort of coming off of some pretty beaten down levels. Things like travel and tourism, hotels. These are groups that are sort of testing swing lows and bouncing off of them. So I don't feel great about the long-term perspective of those, but worth paying attention to. Delivery services, that's FedEx and UPS overall doing very, very well. We need to take a quick commercial break. Back with my guest, Jeff Huge. We'll see you in a minute. Hello, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. Appreciating you joining us every weekday for The Final Bar. As a reminder, we love to hear your questions on anything, questions on particular charts you're looking at, technical indicators, portfolio construction, whatever macro themes, whatever you're running into, we'll do our best to help point you in the right direction. A couple ways to get your questions to us. Number one, email thefinalbar@stockcharts.com. Number two, on Twitter, just tag us in a comment at finalbarsctv. Number three, if you're watching any of our content on YouTube, just put a comment right below the video. We'll capture all those. We're going to do another mailbag segment later in today's show. We'll do another one at the end of the week. So please get your questions in, and we'll hopefully answer one of your questions on the air. I want to get to my guest, Jeff Huge. We sat down with Jeff. Boys, the end of last year, Jeff. It feels like so long ago. Back when we were all able to travel and come visit the beautiful state of Minnesota. But we've enjoyed having you on the show since then, and it's a pleasure to welcome you back here today.
Thanks for having me, Dave.
So when we were talking just before we started the show, we were talking about sort of this bull and bear scenario, which you beautifully outlined with some counts. Walk us through, what are you seeing big picture here?
Yeah, so our working hypothesis has been for some time that there's two potential paths for the S&P right now, two valid Elliott Wave counts that really kind of give us that, wow, we're at this juxtaposition where the market really could go either way. And it's just a question of, perhaps a catalyst, who knows, with something political or having to do with stimulus. But one way or another, the market is going to resolve this count. And so, we can dig into the details of these counts and the analysis, and, we can come up with things like a variety of open chart gaps and, negative divergences in breadth and weak internals, which tend to give us this, underlying sort of preference for the bear case. But on the other hand, the bull count's just as valid, and maybe we're seeing a breakout and a breadth thrust and things are about to change. We really don't know. And so, the reality of the situation is that we can really just simplify the analysis the way I've laid it out in the next slide.
Okay.
And that really kind of identifies the recent trough and the recent peak as being resistance and support. And we can kind of bifurcate those two with the February high, which comes kind of right in the middle. You're about 200 handles above that median line and 200 handles below before you run into key resistance or key support. And I think if we resolve in one direction or the other, that's going to make the decision for us as traders and investors how we need to react to it. And so at the end of the day, I think what investors are faced with is a choice here. Like, do I press my long bets at this point, or are we too long in the tooth? And are we in fact on the precipice of a deeper correction and perhaps even a bear market, which is a discussion for another time. But I think this range, which is, roughly, 400 handles in full scope, will resolve 400 handles higher above the resistance line or 400 handles below the support line, if in fact it resolves one way or the other. So we've come up with some targets. Potentially on the bull side, we could get to around 4,000 on the S&P 500. And I know there's a lot of media pundits and strategists that have been on CNBC and other networks talking about these levels that, they're very bullish and this is the target area. And there's a technical case to be made there, but there's also a technical case to be made for a sell-off to around 2,800 and potentially even lower. So we've identified those as kind of our interim targets based on the resolution of this range.
Got it. So the question, the question is always then, Jeff, is where do we look, right? Where's the opportunity? So you've brought some individual names with you.
Exactly. Our relative strength work has really been zeroing in on industrials as well as materials stocks as being able to capitalize on the momentum that's in the market right now. And we use a couple of different measures, kind of the traditional ratio analysis as well as the RRG. And the chart that we have in front of us is a cyclical name, Caterpillar. Company makes adult-sized Tonka toys. And they will probably benefit from a big stimulus or perhaps a Biden presidency if he were to alleviate some of the restrictions on China trade. And so as a result, we're kind of in the cyclical neighborhood, the bull camp if it works out. But at the same time, we can see that if it doesn't work out, well, it's at least a leadership play right now and could potentially fall less than other names in the market. And the other side of that is we can really define our risk pretty simply by putting a stop loss below perhaps the 10-week moving average or the 50-day moving average, to simply say that if the stock were to close below that level, that we would move to the sidelines and wait for more information. The idea, though, is how do you come up with an idea like Caterpillar for specifically? And what we do is we screen for a couple of things. We're looking for 52-week highs. Okay, 52-week highs typically don't have a lot of unhappy shareholders. Better yet, if we can find all-time highs, we have no unhappy shareholders in the stocks that we're buying, which means that there's kind of a free road ahead of us, or a lot of runway for those pilots in the room, right? Where, the stock can run if it starts to get some momentum. And in this case, the stock has good momentum. And so, the next point is, well, what could a potential catalyst be? Well, we've got quarterly earnings report coming up on October 27th. And so, that could be good or that could be bad. If the stock was very extended, I would say, gosh, if we've had a nice run in the stock and we've been in it for some time, I would start to maybe tighten up my stops ahead of those earnings, or even take some profits thinking that, it might be a sell the news sort of situation. But following a breakout like this with new 52-week highs, that tells me that investors probably know something, or that expectations are fairly low and the company could easily beat those expectations. And we could see a fairly positive response to that on the upside. So there's your catalyst going forward.
It's such a great chart, Jeff, and it reminds me in my Fidelity years. So one of my mentors once said, "Price goes up for a reason, and price goes down for a reason." So when price is going higher, there's an expectation baked in there, and I think you've made the case for this particular chart. Jeff, it's so awesome to have you back on the show. Thanks for giving us sort of this binary, potential outcome for stocks, and then give us an individual name to think about. Hope you and everyone around you stay safe, and we'll look forward to talking to you again soon. All right.
Thanks, Dave. Likewise.
That's Jeff Hughes from JWH Investments, located in the Minneapolis area. It's really, again, I love his take on things. And in particular, I think a lot of times, especially when stocks have rallied, people get nervous about, buying the new highs list, thinking that you're too late to it. And I think if you look back in market history, what Jeff's point is, if you look back, you will find a lot of times when stocks made new highs and then continued on to make many more new highs after that, that oftentimes is the beginning of something good. It's not the end of something. All right, we need to get on to our next segment, which is the final bar mailbag, answering some of your questions that you sent in recently. We received some really good questions. I'm going to do my best to get through as many as possible. Here we go. Question number one. Apple has broken its 50-day moving average and seems to be in trouble. The daily 100 and 200-day moving averages are the next targets. But my question is the daily or the 4-hour, the 1 hour, the 15-minute charts, which ones are representative of true market conditions? Which is it's a really interesting way that you phrase that question. And this is kind of what you're pointing out. This is, I think, yesterday when you might have sent that in, but this is the 50-day moving average here in blue. This is the 200-day moving average in red. I have the 100-day, but it's essentially right here in the middle at this point. And your question was, we've broken the 50-day. Things seems to be getting a little weaker. Next downside targets are these moving averages, but what's the best? What's most representative of true market conditions? I think the way you have to answer that, it really depends on your horizon, right? If I'm looking at this chart, this may be the way I digest Apple, is looking at the weekly chart for the last, 6 or 7 years, because I'm more of a long-term time frame and really trying to understand the next year or two. But if you're a swing trader, looking at an hourly chart or a 15-minute chart or even a 5-minute chart might give you a much better read at some of the inflection points in that shorter term time frame and help you understand how the stock is trading around its 50-day moving average, right? Pulling back from the 125 level. So it's hard for me to answer that question specifically. That's something I think you as an investor have to really, or a trader, have to answer. Question number one is, what game are you actually trying to win? Are you trying to look out a couple minutes, a couple months, a couple years, a couple weeks? And the way you answer that question, I think, should define the types of charts that you look at. For just for the sake of the show, we usually default to the 1-year daily chart because I think that's a pretty common time frame. I mean, even if you're a short-term trader, I feel like you want to get a read on this. If you're a long-term investor, this is as short as you would probably get. So it's kind of like the most common denominator I think we can use. Having said that, I think depending on the time frame you're looking at, I think is pretty key. With what we are usually talking about, it's more of that medium term time frame, kind of 3 to 6 months. I think I agree with what you're saying, which is, we're testing the 50-day. We really didn't follow through from yesterday's breakdown, so I don't know if I would agree with we've broken the 50-day yet. For me, breaking it means you've actually followed through, you confirmed it. If we do, I would immediately be looking down to 105, which is that last swing low. And then I think you're right in looking down a little deeper. Fibonacci retracements might be really helpful there as well. I don't have them on the chart, but that's what I would look at. Question number two, what would the markets look like in the event of a contested election? Some financial types are dismissing this possibility, but right now no one really knows. So what's interesting is I think, and again, your question's phrased beautifully, no one really knows, and that's true. So what you have to remember is the markets are a discounting mechanism, and it's pricing in people's expectations. People are sort of naturally putting in a probability of an election going smoothly and one of the candidates winning, or that it's contested and it might drag out for 6 weeks. Who knows what the answer is going to be, and none of us really do know. So the best thing you can do is look at the charts and understand what people are pricing in, and then make some expectations. We talked about this a little bit on the presidential cycle panel on Monday. I'd encourage you to check that video out to see what the experts there said. But overall, this isn't something. There haven't been a ton of observations. So if we compare it to Bush and Gore, with that contested election again, I would. That this might be a much bigger, more contested election, given everything that we're all hearing. So that's not really something that I've seen in my lifetime or have been investing around. So I'm not really sure what it is. What I do know is that the market has had plenty of uncertainty and plenty of black swan events. So I think looking back at what has happened, I think would be most helpful. In general, I don't think a contested election that drags on is going to be good for the markets. I can't imagine that being a catalyst to positive trends, but there are also a lot of other things like stimulus, like the economic shutdowns or reopenings that could certainly be part of that mosaic as well. Next question. In the last 6 months, I followed all your shows. Thank you so much for that. I've heard you often mention the market going back to test previous lows and or support zones. I see in many cases the market's done that. I can't see that we ever went back even close to test the massive bottom of March 23rd, around just below 2200. I'm sure there's no law that says major bottoms have to be tested, but I'm curious as to why technicians think we never did go back and retest it, or do you think that sometime in the future we will go back for the retest? Decent question, and to be honest with you, I don't know. The idea of us going from where we're at now and getting back down to 2200 seems absolutely absurd. But when anyone asked me here, and again in late March, if you told me we were going to go and round trip very quickly back and eclipse the highs before year end, I would have called that equally absurd, and I probably did on the show, because that just seems so unreasonable. So there is certainly a possibility. And while it's a low probability that I think we would round trip to that, it certainly can happen. If you look back in market history, there have been plenty of times when we retest lows. And if you look back to secular bear market periods or even cyclical bear markets, you'll find times when we undercut previous lows. And that could be shorter term things like 2015, 2016. We very quickly came back and retested the low. Something like 1974, we completely undercut a previous low. That was more of a long-term thing. So what can happen? I think, the real, if you think about the weekly chart of the S&P and you look at the longer term perspective, the question isn't, are we going to go down again? Because we are. The question is, how much lower do we go? And again, we now have the low from 2018. We have the low from 2020, and there are plenty of other swing lows between there. For me, I'm seeing a lot of opportunities between where we're at and where we would go there that would provide potential support. Jeff Hughes was talking about level 3,800 or so, which would be sort of, midway of the way down there. I think if you look at the Fibonacci retracements, you'll find some key levels of support. So again, is it a possibility? Absolutely. And I think part of being an informed investor, a thoughtful investor, is thinking of something that seems absurd like that and think about what the future path of the market might look like. Think about how you would actually trade around it. What would you see on your positions? What would you see from this chart of the S&P that would tell you, something is going wrong? Just to finish off, and I'm spending a lot of time on this question because I think it was a really good one. There's a reason why I have a trend following model right here, and it has short-term, medium-term, and long-term. Between here and the previous lows, there will be plenty of sell signals along the way, and that's what the trend following model is designed to do, is not worry about what could happen, but just focus on what has happened and recognize when things have turned. So that is the way I would answer your question. It's really, really interesting. And again, when we start turning lower in a big way, you will hear people talking about retesting previous lows. It doesn't usually happen. The market's making new highs, but that's just the nature of speculation, I would guess. We need to wrap the show. Go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the DBC Commodities Index. We didn't talk about commodities a lot so far, but it's worth noting the run up from the lows in April. You then have what is arguably a really classic bull flag pattern, which is a big up run, a lower highs, lower lows sort of parallel correction. We've now broken above that flag, which again, if you measure the runway, if you measure the flagpole and you project that from the highs, it's actually putting us back to retest the highs from January of 2020. I don't know if that entire thing is going to happen, but this breakout above this flag pattern is certainly more bullish than bearish. And that's something I'll be looking at. Chart number two is with gold. Now, a lot of the strength in the DBC is the strength in oil in the short term. Gold is also a part of that too, but to a lesser degree. And if you look at gold, it really hasn't broken out yet. It's really stagnated around this level just below this Fibonacci retracement with the GLD around 180. I think a break back above the 50-day, a break above these swing highs would potentially open this door, finish this higher lows, higher highs, ability to retest the previous highs around 194 to 195. So that's another potential breakout I would be looking for right there. Finally, I mentioned in healthcare, there's a bit of a differentiation between stocks that are working and stocks that aren't, but overall the sector is having some trouble, and it's some of the mega cap, big cap pharma names, Johnson & Johnson, Merck are stocks that we've looked at randomly. What caught my eye this weekend and again this morning was Amgen. If you look at biotechs, again, there's some differentiation within biotechs, but Amgen's really at a key point here. It just broke down below 234, 235. These are the swing lows from August and also from early October. Now testing the 200-day, the RSI right at 40, and the relative strength testing a new 6-month low. So I think if that breaks down there, stocks like that struggling to hold support does not tend to be a good thing for the overall market environment. So you have a group like biotech at times which have been very promising, really showing some potential weakness. That's our show for today. Thank you so much for joining us every weekday for the Final Bar. Special thanks to Jeff Hughes, CMT from JWH Investments, joining us from Minnesota. Get your questions to us via email anytime you can. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.